If you're looking for a safer investment option with stable returns, debt mutual funds might be the perfect solution for you. These funds are particularly suited for conservative investors who seek stability in their portfolios without the higher risk associated with equity investments. In this video, we will walk you through the concept of debt funds, their types, and also their benefits, and how they can be a valuable addition to your investment strategy. And with Stack Wealth, we make it even easier by offering customized debt portfolios managed by experts who adjust them based on the market conditions. Do you already invest in debt funds? Let us know in the comments below. Debt mutual funds are investment vehicles that primarily invest in fixed income securities such as bonds, government securities, and corporate debt. Unlike equity funds, which invest in stocks of companies, debt funds focus on earning a regular income through interest from bonds or other fixed income securities. In simple terms, debt funds pool money from investors and invest it in a basket of debt instruments, which could include like government bonds, corporate bonds, treasury bills, and other fixed income securities. The returns from these funds are largely driven by the interest paid on the bonds and securities in the portfolio. There are several different types of debt funds, each suited to meet specific financial goals and risk tolerance. Let's go through the most common types. Liquid funds. These are short-term debt funds that invest in short duration securities like treasury bills and certificate of deposits. They offer high liquidity and are ideal for investors who need to park their funds for a short period of time, usually up to 3 months. The returns, while modest, are stable and relatively risk-free. Short-term debt funds. So these funds invest in debt instruments with a maturity period of 1 to 3 years. They provide better returns than liquid funds, but come with slightly higher risk due to fluctuations in interest rates. Long-term debt funds. Now, these funds focus on debt instruments with longer durations, like 3 or 5 years or more than that. They typically offer higher returns compared to short-term funds, but are more sensitive to interest rate changes. Investors with a long investment horizon can consider these funds for more substantial returns over time. Corporate bond funds. Now, these funds primarily invest in bonds issued by corporations or companies. Now, they offer higher returns compared to government securities, but come with additional credit risk as corporate issuers may default on their payments. Now we have Glit Funds. These funds invest in government securities and are considered one of the safest forms of debt investing. While the returns may not be as high as corporate bonds, the risk of default is negligible, making Glit Funds a popular choice for conservative investors. Next, we have dynamic bond funds. So these funds actively manage the duration of the portfolio based on the current interest rate environment. Fund managers adjust the portfolio's duration to optimize returns, making them ideal for investors who want to benefit from the changing interest rates. Finally, we have credit risk funds. Now, these funds invest in debt securities that have a higher credit risk. While the returns may be attractive, these funds come with the risk that the issuer may default on their payments. So, why even consider debt mutual funds? The thing is, debt mutual funds offer several advantages, especially for conservative investors who are looking to minimize risk while earning stable returns. Let's go through some of the key benefits. Number one, lower risk compared to equities. One of the biggest advantages of debt funds is their lower risk profile compared to equity investments. While stock prices can fluctuate significantly, the returns on debt securities are relatively stable. For investors who are risk averse or looking to preserve their capital, debt funds can provide a very safe option. Next, debt funds generate returns in the form of regular interest payments from the bonds or securities within the portfolio. Now, this makes them an attractive choice for investors looking for steady income, especially retirees who need regular cash flow. Next, debt funds offer a way to diversify an investment portfolio, reducing the overall risk. By including debt funds alongside your equity investment, you can build a well-balanced portfolio that is less susceptible to market volatility. Now, debt funds are generally more tax efficient compared to fixed deposits or traditional saving instruments. If held for over 3 years, the returns from debt funds are subject to long-term capital gains tax, which is usually lower than the tax on interest from fixed deposits. Now, most debt funds are highly liquid, meaning you can redeem your units quickly and easily, making them ideal for investors who may need to access their funds at short notice. However, the liquidity may vary depending on the type of debt fund. Now, debt funds generally have a lower expense ratio compared to equity funds, which means more of the returns go directly to the investor rather than being eaten up by the management fees. When selecting a debt mutual fund, it's important to consider several factors to ensure it aligns with your financial goals, risk tolerance, and investment horizon. Here are some of the key aspects to keep in mind. First thing, you need to look at the credit quality. So, debt funds invest in securities of varying credit quality. It is crucial to look at the credit rating of the instruments within the fund's portfolio. Funds with high quality bonds, such as AAA rated bonds, tend to offer lower returns but come with minimal risk, while lower rated bonds may offer higher returns at the cost of increased risk. Next thing to consider is the duration and interest rate sensitivity. The duration of a debt fund determines how sensitive it is to interest rate changes. Long duration funds tend to be more sensitive to interest rate fluctuations, meaning their returns can be more volatile in a rising interest rate environment. Short duration funds are less affected by such changes. Next thing to consider is the expense ratio. Now, while debt funds generally have lower expense ratio than equity funds, it's still essential to check the expense ratio when making a selection. A high expense ratio can erode your returns over time. Now, this is pretty important. Yield to maturity. The yield to maturity is the total return an investor can expect if the debt fund is held until its maturity date. A higher YTM usually indicates a higher return, but may also come with additional risk. Finally, the most important thing to look at is the fund manager's track record. The success of a debt fund is often tied to the expertise of its fund manager. Experienced managers with a solid track record of navigating interest rate cycles and managing risk are key to a fund's performance. So, why consider debt funds? Now, debt funds are an excellent option for investors who want to preserve their capital while earning steady returns. They are particularly useful for short term goals, such as saving for a down payment on a house or building an emergency fund. Additionally, debt funds are ideal for individuals looking for a stable income, such as retirees or conservative investors who prefer low risk. Debt funds can also complement a portfolio with equity investments by offering diversification and reducing overall risk. If you're someone who prefers a lower risk approach to investing, debt funds can help balance out the volatility of equities. Now, debt funds and SIP are a very interesting combination. Debt funds invested through SIPs are ideal for short to medium term goals like funding a vacation, buying a car, or making a down payment on a house. You can also use debt funds to maintain a balanced portfolio, such as 70% equities and 30% debt. However, not all debt funds suit SIPs. Now, when it comes to SIPs and debt funds, it's better to avoid short-term funds, example, overnight or liquid funds, and long-term funds, example, gilt funds or long-duration funds, due to their sensitivity to interest changes. You should opt for funds with an average maturity of between 1 to 5 years for a better match of your goals. Now let's compare debt funds to FDs and RDs. Debt funds can offer better post-tax returns compared to fixed deposits or recurring deposits. While FD rates are usually close to 5.5%, the post-tax returns for those in higher tax brackets can be under 4%. However, for debt funds held for over 3 years, investors benefit from indexation, bringing the tax rate down to under 10%. Now, debt funds are more beneficial for those in higher tax brackets, especially for short to medium term goals. The strategy of investing small amounts through SIPs can help you achieve your goals efficiently. Debt mutual funds are a solid investment option for conservative investors who are looking for stability, regular income, and low risk returns. By diversifying your portfolio with debt funds, you can benefit from a steady interest income while reducing the overall risk of your investments. If you are considering debt funds as a part of your investment strategy, make sure to carefully evaluate your goals, risk tolerance, and the type of debt funds available. Whether you're investing for short-term financial goals or seeking long-term stability, debt funds can offer a reliable and tax-efficient way to grow your wealth. Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.